After the end of the first displacement, this is the first displacement. All right. So this right here, as soon as you grab liquidity and you break structure, this is your first displacement. That's how my brain understood it. First displacement. All right. And the first displacement, the top of the first displacement is the long-term high. The bottom is the long-term low. Soon as you get that, as per ICT, you look for an imbalance. You wait for your trade on that imbalance. My original question is, how is that intermediate, how are those intermediate term highs and lows being formed? Well, the pullback you get from your long-term low, which is the end of the first displacement, all the way to the imbalance that you get, that pullback ends up giving you the intermediate term high. Intermediate term high. Right there. This is your imbalance area that the market came back to grab and get down. Now, how do you wait, or how do you identify the intermediate term low? Why is this the short term low and not this? Well, that's because soon as you grab the imbalance right here, as per ICT, the market is supposed to reject it very fast. Like this. Not to be confusing. The market is supposed to give you a second displacement after the test of the imbalance, as per ICT again. That second displacement is called, that's what he calls the intermediate term low. Now, let's just stop here for a second before getting into the whole short-term high, short-term lows, and all of that stuff. We're going to think about it a little bit later. For now, let's just focus with these fours: long-term high, long-term low, intermediate term high, intermediate term low. Initially, what we are dealing with here, not initially, but essentially what we are dealing with here is a sequence of events, or a sequence that happens after you get the ICT signature. I use the word sequence, and this is the definition of it: a set of related events that follow each other in a particular order. If you remember, ICT keeps saying that these markets do not behave randomly. And I remember in one of his videos, I think it was in the Market Maker series, he says that he truly believes that these markets are handled by algorithm, and there is a program set to behave in a certain way with a lot of programming rules like if, else if, true, false. We are dealing with a sequence of events that is supposed to happen once you get the ICT signature. Let me redraw this properly so that it makes sense, and I'm going to show you what that sequence looks like. So you have the ICT pattern signature here. This is the pattern. This is the signature. All right. The sequence starts when you get your test of the imbalance. So you have the displacement, break of market structure. The first step of the sequence that you wait for from a programming perspective is, do we have an imbalance left behind? Yes. Boom. Then wait for trade there. That's the first stage of the sequence. You take your trade there. This becomes your intermediate term high. Actually, I'm going to write that over here as well. This becomes your intermediate term high. Right after that, the sequence follows up by giving you a second displacement. Now, ideally, the second displacement is supposed to take out this long-term low. Long-term low. And here, long-term high. Now, yeah, as I was saying, ideally, this second displacement is supposed to take out the long-term low. However, it doesn't have to do it all of a sudden. It doesn't have to do it directly, Because there is another point that ICT mentions in this video, which is you always, in that same episode 12 video, I did not save the clip, I just thought about it, I should have saved that clip, but you always need to ask yourself a question. Is there any reasons for the market to come behind or return into the range before continuing its movement? It's before continuing the order flow movement. And those reasons are what? Well, is there an imbalance left behind? Is there an order block left behind? Who even knows? Is there a pool of liquidity left behind where the market can tap into with an imbalance above it to then drop? Like the example we have here. We had an imbalance here. We had an imbalance here. The market left all that shit and went and tapped into the imbalance up here. Why? Because there was a pool of liquidity here. You always have to ask that question. That's why within this sequence, sometimes you're going to have the second displacement, like this displacement, this entire thing here, the second displacement acting like this instead. I hope I'm not making it even more complicated, bro. That would piss me off, because I'm really trying to help you guys. You get your test of the imbalance, you get your second displacement, but it happens so fast it doesn't break this. You get a retest inside, then a drop. It's still the same sequence. It's just on the second variation of this particular sequence, in the formation of the swing candlestick, the market may want to deliver it in a different way. However, here is the key rule. As long as we don't break this, anything that happens right here, we don't even have to worry about it. Anything that happens in here, right there, all these things here, the short-term high, lows, things that ICT mentions, we don't even have to worry about it. Soon as we tap here, our eyes is down here. However, we keep in mind that the market may be interested in delivering it either directly or in different phases. And the reason why you get the intermediate term low is because during the delivery from the long-term low to the imbalance that gets you in the trade as per ICT, if during that delivery, the delivery leaves an imbalance or an order block in this, in this entire movement, as you see here, then as you're asking yourself the questions, just like ICT says, is there any reason for the market to either stop me out or to go to an imbalance, to slow down and test that imbalance, etc., 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 you will realize that, well, for this intermediate term low forms because indeed in this pullback towards the imbalance up here, the way the market delivered it left this order block and imbalance level right here. So a test should be expected in this area. That just might slow down the process of this one, and that slowing down creates these short-term highs and short-term lows. All right, so I just wanted to add that. I completely forgot to mention it as I was doing the video. And those different phases is what ICT is teaching, with short-term highs, short-term lows, short-term highs, etc., etc. That's why I said we're going to touch on this later, because imagine for a second this was not there, then you would have a long ass displacement. If this wasn't here, you would have only had this candle, and then the rest of these candles. But the market choose to go through these phases, the second variation of the sequence, before dropping. It's still the same thing. Now, after the second displacement, so remember, displacement 1, displacement 2. ICT, in the ICT example, he is showing us the example of the second variation of this sequence. Hence why he said in between the long-term high and the long-term low, in between those two swing points, he is expecting an intermediate term high and an intermediate term low. That just means what? That just means inside of these two, we had an intermediate displacement where the market felt like, well, before moving forward, I just need to go back and fix the mess I've made up here before continuing. That's all that is. All right. Now, you get the intermediate term high. We break down here. You get another long term low. And what should normally happen after that is a retest of this previous long-term low and then a continuation to the downside. Same scenario here. After this, what you should normally get is either a retest of this long-term low or a retest of this intermediate term low and a continuation to the downside. Ideally, the same goddamn thing. I'm going to put annotations here as well. So you're going to have long-term high, long-term low, intermediate term high, and intermediate term low. The way I understand it, I don't need to care about this bit. All I need to know in both sequence, which is the same thing, but both variation of the sequence, is that as soon as I tap in my imbalance, bro, my eyes are here. And I don't want the market to break this back, to break this to the upside. That's all. If the market breaks this to the upside, soon as I'm watching the market move, I see that the market has reason to pull back. Yeah, I am letting those reasons to be revisited by the market. As long as those reasons don't break this high, I'm fine. I stay in my trade. In this particular example, soon as we break this high, I'm stop. My hand is already on the sell button, on the buy stop button. I'm not even fucking around. And I'm going to show you the same thing that happened on S&P, where I almost got stopped out, and I got lucky on that one, and I didn't get stopped out, and the trade went down for 4 days straight. So this is what you're dealing with. Now, here is why you find a problem. I said we are dealing with a sequence to form a swing. The swing pattern in itself, the swing candlestick pattern. All right, this is the sequence that unfolds. The problem that I think people do have is what? Because the example that ICT showed is another variation, they expect this example to be the same every single time. No, it's not. Actually, one thing that I noticed in my backtesting when I was studying this, the market structure for ICT market structure, if I should just call it like that, is that you are likely to get this action when we are dealing with a higher time frame swing pattern. If you are dealing with an intermediate time frame swing pattern, you are likely to get this version rather than this version. And sometime this pullback on an intermediate time frame is going to run up all the way here. And when it does that, you get confused. No, it's literally the same goddamn thing. Literally. Only difference is this is more, you are more likely to see this happening if you were looking at it from a higher time frame perspective, like the daily or something like that. And this is more likely to happen if you were looking at, let's say you saw this happening on a 5-minute chart, for example. You are likely to have something like this, or even the 2-minute charts. Go on ICT episode number 4 or number 3. ICT episode number 3. You will see it on a 2-minute chart. Everything, all of this happens straight, very straight. No, no wasting time with all this short-term highs, short-term lows. Nope. Tapped into the imbalance, continued its move without, like, if nothing happened, bro. You know what I mean? So here, you're likely to see this happening on a micro, lower time frame type shit. And this is more of a higher time frame delivery. So, that being said, let's find other examples. I hope I did not complicate complicated this even more. I really I really hope so. Bro, if I did, please let me know.